You ever looked at a big apartment building and thought, how in the world can somebody afford to buy that? The secret? They probably didn't do it alone. So imagine teaming up with a group of your friends to buy something really expensive, kind of like a fancy car and then sharing it. Well, in the real estate world, this teaming up is actually called a syndication. It's like a group project where everybody pools their money to buy these big properties. And in this video, we're going to explore the two popular ways to do these group projects called 506b as in Bravo, 506c as in Charlie offerings. Well, don't worry if these sound like complicated codes because we're going to break them down in very simple terms just for you. And if you're new here, I'm Dr. Jeff Anzon, a periodontist on a mission to get you out of the rat race. Do me a favor, download the free passive income guide with the link below this video. So let's start off with the question, what is actually a real estate syndication? So imagine back when you were a little kid and maybe you're like 10, 11 years old and you and your friends, you go into this toy store and you see this really cool new toy, but it's just too expensive for just any one of you to buy on your own. So what do? You chip in, you all buy the toy together and then you share it. Well, that's the basic idea behind a real estate syndication. But instead of toys, we're talking about big properties like apartment buildings, RV parks, that sort of thing. Here's how it works. First thing you do is you team up. A group of people called investors or limited partners, they come together. Each person contributes money. Second, they find a leader. So it could either be a one person or it could be a small team called a syndicator or a sponsor. They're the ones that take charge. They're responsible for finding the property, managing and taking care of it basically after it's bought. The third thing is you go in and you buy together. So everybody, remember, using everybody's pooled money, the group buys the property. The fourth is you share the reward. So any money that the property makes, like rent from tenants or any increase in the property's value, it gets shared among the group. And the last but not least is the exit strategy, because after a set period of time, which we'll get into in a minute, the property might be sold and the profits are divided amongst all the investors. So why should you even consider syndications in the first place? Well, first thing is you can afford bigger deals. So by pooling money, you can invest in larger properties that may be out of reach individually. Second is you get to learn from experts, especially if you're new to real estate, because syndications often have experienced leaders guiding the project. And now that's going to give you a chance to learn while you invest. And I see a lot of this in my passive investing group. People with no real estate experience, they automatically want to jump into real estate. They want to be an active investor. And I tell them, why don't you consider starting learning from experts, invest passively? That's the route that I did. You start doing that, and as you start learning, you get a little more comfortable in it, and then you kind of figure out which direction you want to go. Another thing about syndications, you get to diversify. So instead of putting all of your money into the stock market, which is unfortunately what most people do, you can now invest in assets that not only appreciate or go up in value over time, but also they're providing you with cash flow to replace your expenses. And probably one of my favorite things is they're hands-off investment. So if you don't want the hassle of being a landlord, then in a syndication, the day-to-day management is usually handled by the syndicator or the sponsor. All right, so we've talked about teaming up to buy big properties, but just like there's rules in a board game, there's rules for these real estate group projects too, okay? These rules make sure that everything is fair and transparent for all the people that are involved. And we're going to get into what's called Regulation D and the SEC. So who makes the rules? Well, there's an organization, just like I mentioned, called the SEC, which stands for the Security and Exchange Commission, not the Southeastern Conference. Think of them as the referees or the umpires in the world of investments. They're the ones that set the rules to protect investors like you and me. Now, you mentioned Regulation D. What is that, Jeff? Well, among the many rules that the SEC has, there's one called Regulation D, as in David. This rule talks about how money can be raised for business projects, including the real estate syndications that I invest in. So it's kind of like a guidebook for how group projects basically should work. So why does all this matter? Well, just like you'd want to know the rules before you play the game, right? Understanding the basics of Regulation D helps you play the real estate investment game wisely. So it really ensures that you're part of a legit deal and not falling for a scam. So we talked about syndication, we talked about Regulation D. Now let's talk about the two different types. We're going to start off with 506B as in Bravo first, okay? Remember when we talked about that rule book or the Regulation D, right? So within that rule book, there are specific chapters or ways to do a real estate group project. And one of the most popular chapters is the 506B offering. All right, so let's break it down. The first thing is it's a private club. So think of the 506B offering like this private club. So you can't just go out and tell everybody, shout out to the world that, these sponsors can't go and just go, hey, I've got this group project. They can't go tell everybody, okay? And they can't ask anybody to join. Instead, they have to invite specific people that the syndicators already know, okay? Number two, who can join? Well, in this club, there's actually two types of investors. The first one is an accredited investor. And these are the big players. They either have, you're accredited based either on your income or your net worth. So with the income, you're making $200,000 a year single, or $300,000 a year married, filing jointly, or you've got a net worth of $1 million, not including your personal residence. All right. So that's one of the people that can join this club. Or you've got something called a sophisticated investor. Now, these folks, they may not have the big bucks that the accredited investors have, but they have the experience, they have the knowledge in investing. They could be, let's say, like a new physician or new dentist out of school, and they're making good money. They have some business sense, but they're not quite accredited yet. So actually, in a 506B, the sponsor can have up to 35 sophisticated investors. Now, one of the biggest difference between a 506B and we're going to get to in just a minute, the 506C, is this: no advertising in the 506B. So in the 506B club, the sponsors just can't go put out there these flashy ads or make public announcements about their project. Everything, again, is kept private. And then last but not least, you always want to trust but verify. So people who want to join this club as accredited investors, they can simply just say that they qualify, okay? It's like a trust system. If you're an accredited investor, you invest in a 506B, then you can just say you're accredited and the sponsor is going to take your word for it. But if you're the sponsor, it's always a good idea to double check, okay? Now let's talk about the 506C offering. So while the 506B is like a private club, the 506C offering is more like a public event where everybody's invited, but there's a catch. There's actually a VIP section. Let me explain. So here's the breakdown. The first thing is it's an open invitation. So with these projects, the sponsors can go and tell anybody about their project. This means they can advertise on social media, Facebook, Instagram, YouTube, websites, newspapers, radio, anything. It's open to the public. And I talked about the VIP section. So even though everybody knows about the project, not everybody can join. Only the VIPs, and the VIPs are these people, the accredited investors. They're the only ones that can invest. So remember, these are the ones with a high income or the net worth, excluding their primary home. Strict entry. So unlike the 506B, where investors can just simply tell the sponsors that they're accredited, in the 506C, there's actually a strict check. There's actually a bouncer at the door, okay? So they're checking these investors before they get in. This means you actually have to provide documents that you're an accredited investor. Like, one of the simplest, quickest, easiest ways to do it is just to have your accountant write a letter that basically tells that, have the date on there that tells the group that you're accredited based on either your income or your net worth or both. Or you can go to websites like parallelmarkets.com. It's a free website. Verifyinvestor.com is another one that you can have the documentation. So then anytime you get into a real estate syndication, you just provide that document. So why the strictness? So since the offering is public and it can attract a lot of attention, the rules now are more strict to ensure that only those who understand the risk can afford the potential losses that get involved. Basically, it's a protection for the investors. All right. By now, hopefully you have a good grasp on the difference between a 506B and C offering. But when you put them side by side, how do they stack up? All right. So let's compare both of them. So remember, with advertising, 506B, it's like a secret club. No public announcements or flashy ads. The sponsors can only invite people that they already know, versus the 506C. Sponsors can advertise their project anywhere, social media, radio, billboards, whatever. Who can invest? 506b, you've got that mix, VIP or accredited investors, and up to 35 sophisticated investors that, again, they're not accredited yet, but they do know a thing or two about business or investing, versus the 506c, VIPs only. Every single investor has to be an accredited investor. And then remember, proving VIP status. 506b is based on trust. Investors can just tell sponsors that they're accredited without showing proof, versus 506c, strict door checks. Investors have to show those documents. Now, I run a group for accredited investors only called the Passive Investor Circle. I'll leave a link below this video. And at this time, we have just a little bit over 2,000 investors. Now, what I want to do is share with you a few of the most frequently asked questions that I get from new investors on a regular basis regarding real estate syndication. So they usually say, Jeff, what's the minimum to get involved? Every deal is different, but typically the minimum investment for a syndication can range anywhere from $50,000 on the low end to $100,000. But again, it varies on the deal and the syndicator. Number two, how long is my money tied up for? Most syndications have a projected hold time anywhere from 5, 7, sometimes 10 years or longer. However, again, this can vary depending on the property, the market conditions, and whatever the strategy that the syndicator has. Third, can I exit early? Exiting a syndication early can be very challenging because it's not as liquid as stocks. However, there are some situations where there may be some buyout options, but it's always a good idea to discuss this with the syndicator before you invest. Number four, how often am I going to get this cash flow or these returns? Most of the deals that I'm in, they distribute the returns quarterly. Once a project closes, anywhere from 3 to 6 months after the property closes is when you'll start getting your first distributions. The majority of the ones that I'm in are quarterly, but some might also do monthly. Again, it depends on the property's cash flow and whatever the sponsor's agreement is. 5, are there any fees involved? Yes. Just like financial advisors have fees for assets under management, where they a lot of times really don't do a whole lot, but sometimes they do, most of the times they don't. The syndicators, they do charge fees for going out, finding the properties, managing them, acquisition fees, asset management fees, and then eventually when they sell, they have these disposition fees when the property's sold. There's closing costs and there's brokerage fees, that sort of thing's involved. Number 6, is my investment safe? All investments come with risk. If somebody tells you there's risk-free, run. Do not do it. So while real estate is generally considered stable, there are factors like market downturns, property issues, or there could be some management challenges that can impact returns. So again, it's important to do your thorough due diligence and make sure you understand the risk before you get involved. Number 7, can I invest with my retirement accounts? Yes, and I've done it before. Several of my investors have done it, where you can take a self-directed account, whether it's a self-directed IRA or a solo 401k, to invest in syndications. But before you do it, make sure that you have all the right information. Maybe you talk to your tax professional or the sponsor, and they can help you, guide you through the process. Now, there you have it. Everything that you need to know about the 506B versus the 506C syndication. And if you want to learn more about one of my favorite cash flowing asset classes that I'm currently investing in, do me a favor, check out this video.